Welcome to Financial Fitness with the Money Doctor. I'm Denise Bozella, co-host along with Dr. Francis Ram of Hug Your Student Debt. This program is made possible by our sponsors, Greenfield Community College, increasing access to higher education at a fraction of the cost, and by People's United Bank of Amherst, home of tea with Trish. And this morning we're going to be talking about home equity lines. And this is something that I'm very curious about because I've never had one, but we are thinking about getting one possibly. And so all of the information that you're going to share with us this morning, I'm going to be really taking a close look at.
Well, can you tell me why you're thinking of a home equity line?
Yes, well, there are a couple of reasons. There's someone in our family who has a home equity line that they say they use that to fund vacations and all kinds of things, new car purchases. They said we don't really have a lot of money. We just have really good credit. And they use their home equity line for a whole bunch of stuff. And it sounds really exciting to be able to do something like that. But it also sounds a little dangerous to me. We do have some things that we want to do to our home. We need lots of home improvements. Our house is 100 years old and it needs siding or paint. We haven't decided. Windows. It needs a lot of upgrades to the bathrooms. So that's one reason. Another reason is we do have really old cars that we're driving, and sooner than later we're going to need to make a vehicle purchase. And as my husband says, we may only get one bite at the apple here at taking out some sort of loan or debt,
right?
And so we might want to look at that, or maybe not. So yeah.
All right. So let's talk about that. Home equity lines or home equity line of credit is different than a home equity loan. So let's just start there. A home equity line of credit is just that. It's a line of credit based on the equity in your home. Now, if you don't know what the equity in your home is, it's the difference between what you owe on the home and what the house is worth at appraisal. Okay. So if you owe $100,000 on it and the appraised value is $150,000, you have $50,000 of quote equity. Then after that, the bank gets to decide how much of that equity they will allow you to tap based on your credit, your income, and their idea of what the house is worth. All right, that's a home equity line of credit. A home equity loan works a similar way, except it's one chunk of money that you just get up front, and then you repay that over a period of time, let's say 15 years. In other words, the line of credit is cyclical. It's recycling, right? So you can use a little bit, and then you can pay it back. That usually a home equity line of credit, or a HELOC, right? We love all these acronyms. A HELOC is just that. It's your line of credit. And as you use it and begin to pay it off, you have like a 10-year drawdown period usually, which means for 10 years it's very fluid, flexible. You use it to buy cars, vacations, whatever. You make a small payment on it. Very often it's interest only, which we're going to talk about. And then at the end of that 10-year time, typically, the loan will then amortize. In other words, it will become a new 15-year mortgage, essentially, right? So there's a number of problems here. There's a good way to use home equity lines and what I think are bad ways to use home equity lines.
All right. I want to know what the good and the bad are.
So the good way, the times that I recommend a home equity line to people is often for a house repair, right? That's an appropriate place, I think, to be using your home equity line. Your house needs a roof. It really needs a roof. It's not just that you don't like the way it looks and you'd like to put a metal roof on, right? It needs a roof.
Leaks coming into your living room.
You really need a roof. That's a good place for home equity line debt, I believe. But the vacations, I'm not so sure about that. So typically what happens is people use this line of credit for 10 years and they get lulled into a false sense of security of making that tiny little interest-only payment. And, when we first take these things out, we intend to pay larger payments, but it usually doesn't happen. So then what happens is the 10-year mark rolls around. All of a sudden you have a new 15-year payment, which is going to be much higher. And because you've had that extra cash with your little low payment, you've probably racked up some more debt. Anybody out there with a home equity line of credit can probably nod and say, yes, that's what we did. We had a home equity line and we ended up thinking it was our solution, and then we added on more debt. So a good place is to use it for home improvement. That being said, I caution people about not over-improving their home. So this is the big discussion about need versus want.
Okay.
I need a new kitchen. I need a new bathroom. And then the rationalization follows. That's where all the value in our home will be. And if we're going to sell it someday, we have to have granite counters and stainless steel appliances, right? We have to have a marble bathroom. Now, while some of that may be true, a lot of it tends to be a rationalization, and people take on huge debt. They use all the equity in their home to make these improvements, and maybe they never sell their home, in which case you're using your home like a savings vehicle, right? Or if they sell their home, we can't guarantee what the market will be.
True.
So there's always this idea that the houses are going to continue to rise in value. And if you think back to the housing bubble in 2007, 2008, you'll notice that a lot of the foreclosures didn't happen on first mortgages. They happened on second mortgages.
Oh, boy.
And make no bones about it, a home equity line of credit or a home equity loan is a second mortgage. It is secured by your house. So let's suppose you maximize the equity in your house and you spend the $50,000 we were talking about as equity, and 10 years ticks by, and now the loan becomes due in full. So they say, well, your loan is due in full, and we're going to give you 15 years to pay it. If you can't afford to make that payment, guess what's going to happen? Your house is going to be at risk.
Wow.
So you have to be really careful about how you're accessing this equity. It was great propaganda from the government. Oh, we're going to let you tap the equity in your home to do all these lifestyle things you want to do. And by the way, the tax deduction is going to help you. You're going to be able to deduct the interest, right? That's a whole different topic.
I just had my taxes done. That is a different topic.
Yeah.
Yeah.
It is. And I'm not an accountant, but you are supposed to be able to deduct that interest if, in fact, you are using that money to improve, build, or repair the home that you draw that against. So when you're using it for vacations and debt consolidation, you're probably not supposed to be able to deduct that interest.
That makes sense.
So that's one of the good ways to use it.
So how do you know when you mention that term of improving your home?
Yeah.
How do you know what's an over improvement? Is
Well,
it that need versus want?
No, that's a fair question. It's not so much the need versus want. It's a matter of math. If your house is only worth, $200,000 and you owe $175,000 and they're going to give you $25,000 of equity and you're going to use every penny of it to improve the bathrooms, kitchens, whatever, and the market slides at all, you have over improved your home, right? You can't get the money out of it that you owe on it, and you're what we call upside down in the business, right? That's what we call it in cars. When you owe more on your car than the trade-in value is, you're upside down.
But you can't really predict what the market's going to do.
That's right, and that's why you don't max out your home equity line.
Got it.
So what I see happening for some people is they're so worried about getting out of debt, and they're so hungry for some stress relief that they sit down at the kitchen table one night with their spouse or without, and they add up all the credit card debt they have, and they look at the equity in their house, and they think, this is easy money. We can get this home equity line as long as our credit is okay, like your friends, right? And we can just get rid of all this debt that's really bothering us. All these, little credit card payments or big credit card payments, they're all going to go away. And by the way, isn't this wonderful that instead of having this high interest rate on these credit cards, we're going to have this low interest rate? Oh, and we think it's tax deductible.
It seems like a no-brainer.
Yeah, doesn't it? And it's meant to seem like a no-brainer. And I'm not against home equity lines, but I want people to think hard and long before they put their credit card debt or their unsecured debt on a home equity line. And we can talk more about that in the second half and whatnot. Why is that?
Yeah.
Yeah. Well, let me paint a gruesome picture.
Okay.
You have a lot of credit card debt, and the reason you're looking at a home equity line is because financially that seems like an outlet, right? A steam valve, right? And so that is already a sign that you're struggling. Now, you put the credit card debt on the home equity line, and you believe, without any help from someone other than the banker, right, a third-party coach, you believe, okay, this is going to solve our problems. That's why they approved us for the home equity line. And even the bank is saying you have to pay off these specific credit cards or we're not going to give you a home equity line.
Right.
So it feels like you're making a good decision. But let's suppose it doesn't really solve the problem. Let's suppose that your income really isn't enough, or something happens in the future, or you don't change your behavior and you're still, shopping and spending money like crazy because now you feel like everything's looser financially. Guess what happens? If financial disaster strikes, that credit card debt that you could have filed a bankruptcy on, you can no longer file, you can file, but you can't get rid of it on your home equity line because it's secured by your house.
Right.
Now, I have to say that I'm not an attorney, so you can check with an attorney on this. But that's my major beef about moving your credit card debt onto your house, is that you're using the equity in your home to pay what is unsecured debt already, which you could get out of a better way. And I think you're putting your house at risk for something that has happened to you already, and we're not even sure if you've solved that problem going forward.
So instead of using a home equity line to do that, would you recommend just trying to reduce those credit card debts another way?
Well, of course I would, yeah. And even adding in the home equity line. I mean, that's what we do, is we take all of your debt, and sometimes we will recommend a home equity line. I'll give you an example. We're looking at somebody's case, and their debt to income ratio is so high that I just see there's no way they're going to be able to make these monthly payments. And now we have to make a choice between, can we save them, or do we have to send them to bankruptcy? If I look at it and I think, if we moved this debt and that debt, shifted it to someplace else, I could get the payments to be low enough for things to be affordable for them, and then we could apply our system to get them out of debt. Sometimes that is the case for a home equity line, but I want to make those decisions with people in a controlled environment. So to just talk about that for a second. So let's suppose that case. We have somebody whose payments are too high. In order to wrangle them into an affordable range, we're going to use, let's say, their home equity line to move a couple of credit cards or a couple of car payments or something into there, only when it's absolutely necessary, when it's a decision between this and bankruptcy, right? Mm-hmm. So let's say that we do that. We put this debt on a home equity line. That home equity line will have that transition that I was talking about in, let's say, 10 years. I don't want that transition to ever happen. I want to save somebody from financial peril in the future. So what we do is we look at it inside a controlled environment comprehensively with all of your debt. And we see before you pull the trigger, okay, if we shift the debt around this way, where will that home equity line, that new home equity line, be paid off inside our program? And how affordable is it for you? And can we free up enough cash for you to rebuild cash reserves and start living a lifestyle that you can afford? Because the real danger is that people make these decisions assuming that it's been a solution. And when it's not, or when the problem hasn't really been addressed, it's just a quick fix, and it ends up worse off later on.
So this really has to be an individualized plan. You can't say one size fits all when it comes to making these decisions about home equity.
That's absolutely true. I mean, when making decisions about anybody's finances, as much as we can automate things and we can give you software that will help you make these decisions, it's not going to be the same for everybody. And that's why the coaching is so important, right? So if it sounds like I'm blaming people, I have to say that I did this. I had home equity lines. Before I developed the system that we use now, I had 2 home equity lines on 2 different properties because I thought the same thing. I thought, I'll just put this debt that I've got here onto these home equity lines, and I'll get the tax deduction, and I'll pay the low interest rate. And I promised myself, as we all do, I will make the same payment on my home equity line. Mm-hmm. And what happens is, no matter how much we assume that we will do that, it turns out sooner or later we couldn't do it. For 1 month, for 3 months, for a year. I got a divorce in the middle of this. There was no way that was going to continue to happen. So I learned my lesson the hard way, and that's why I look at them the way I do. You mentioned putting cars on a home equity line. Mm-hmm. What you're doing when you do that is you're stretching out your car payment from 5 years or 6 years to 10 years or longer, and you're putting it on your house. That would be fine if you're only ever going to buy one car the rest of your life. But what will happen is you will put the car on your home equity line. By the time you need another car, you've forgotten that the car was ever in your home equity line. So now you're paying for that car in your home equity line and your new car loans. And it's this layering effect that I object to. That's what keeps people down in debt. It's layering on another debt, another debt, another debt with no active way to manage it.
So it sounds like you would recommend against that.
Well, I would recommend managing it properly, for sure.
We're going to talk more about home equity lines, how to use them, how not to use them with the Money Doctor, Dr. Frances Rayam of Hug Your Student Debt. This program is made possible by Greenfield Community College, increasing access to higher education at a fraction of the cost, and by People's United Bank of Amherst, home of Tea with Trish. We'll be right back with part 2. And welcome back to Financial Fitness with the Money Doctor, Dr. Frances Rayam of Hug Your Student Debt. I'm her co-host, Denise Vozella, News Director for WHMP and the Northampton Radio Group. And this morning we're continuing our discussion about home equity lines. And I'm so grateful that I can have a financial coach like you, Dr. Rain, that I can talk to about these things because, as I mentioned earlier, my husband and I are considering the possibility of accessing a home equity line to do some things. And we were mentioning that there are good things and bad uses for a home equity line.
Well, first of all, thank you for recognizing that a financial coach is different than a banker who might be helping you through the lending process, or a financial planner who might be helping you with investments, or your accountant who would be helping you with taxes, right? Finance is such a broad topic that we all have these areas of specialty, and we work together with those people as a team. And if you were with us through the break and heard our sponsors, you noticed that one of them is a bank, and it's not unusual. We work with bankers because bankers are also interested, believe it or not, in how to get you through the lending process in a way that is good for you.
Mm-hmm.
Maybe not all bankers, but the ones we've worked with, I can say, have a heart and they want to make sure that you're doing the right thing. But they might have a little bit of a different perspective than we would have. I'm really in your corner to say, is there some different way we can manage this debt? And oftentimes when I'm invited to come into a bank and speak to the personnel there and explain what we do, I'm met with really a lot of people that are surprised about what we do because it's never been taught somewhere, right?
Even to bankers.
Well, even to bankers, maybe even especially to bankers. Like we talked before about how it's not taught to financial professionals because our jobs are to move these products forward a certain way, which doesn't mean they're trying to take advantage of you. It means that they're very skilled in what they can do to make that loan work.
Mm-hmm.
And so it turns out that we work with bankers a lot on these things. Okay, all of that being said, I'm not a banker. I'm not an expert in that area necessarily, but I think I have a pretty fair handle on home equity lines. So let's talk about one other good way to use them, and that would be, if you've heard of PMI, private mortgage insurance.
Oh, yes.
It would be a way to save yourself from private mortgage insurance, and I find that people don't talk about this. So it's a first-time home buyer or somebody purchasing a new home. And they go to the bank to get a loan, and the bank says, well, we're only going to lend you 90% of your loan to value or whatever their ratio is. And because of that, because you don't have 20% equity in that home, you're going to have to pay private mortgage insurance.
Mm-hmm.
Now, my humble opinion is private mortgage insurance is a waste of money. I can't say it any cleaner way. I don't want people to pay private mortgage insurance if they don't have to. Private mortgage insurance costs you sometimes hundreds per month, and its job is to insure the lender in case you default.
Right.
Now, this is a whole different show about what happened in 2007, 2008 about all those homes that defaulted with people that had PMI, and lenders were still taking them to foreclosure. I have a big question about why that happened.
Oh, my goodness.
But that's, as I said, a different topic. In this case, if you were to buy this home with what is called an 80-20 split, 80% first mortgage, and a 20% second mortgage or home equity loan or home equity line of credit, usually home equity loan, depending on the lender, but most lenders will then say you've satisfied the rules to not have to have private mortgage insurance. However, I don't find a lot of lenders tell the borrowers this, and I don't know
brilliant.
Why. Well, I don't know
I'm
about
serious.
brilliant.
It's brilliant. I've never heard that.
It's a little sneaky, but it's legal.
It's great. Wow.
Yeah.
Do you work with mortgage brokers at all?
We do, yeah. And oftentimes they're totally happy to do that once we tell them. It means more paperwork, but it also means 2 loan applications. And it means lower payments for the borrower, which means the bank is safer. So if it can work, it's a great way. Sometimes we do it with people who are refinancing. They're about to refinance into one loan, and I say, you know what, if we split this, we could get rid of the PMI, we could have this lower payment on the home equity line, we could put it in the debt plan comprehensively and wipe it out in 5 years, 6 years, whatever.
I love it.
And so that's where it pays off to really look at everything under one umbrella.
That's why you're the money doctor.
Thanks. And, I hope bankers will call me and say, gee, that was great. How do we work together more closely to help the clients? Because that usually seems to work well. Let's talk about why people use their home equity lines in percentages. So there's a website called bankrate.com that posts a lot of these sort of surveys, and they surveyed 719, don't ask me why, 719 homeowners. And here were some of the percentages of how people use their home equity line. 73.9% used it for home improvements. that's good
And
if,
that's
if they
something
were
you agree with.
necessary. Yep, especially if they're necessary.
Mhm.
Not so much if they're just, we have this equity and we want to just use it because we can. 44% used it for debt consolidation, and that's the one I'm saying I'm not so sure I'm happy about. And believe me, we don't make any more money if you have your debt consolidated or not consolidated. I just want you to be able to get out of debt.
Right.
And when you consolidate debt, you lump it into this giant debt, and it can take you longer to pay off. And since it's taking you longer to pay off, and since we don't have a crystal ball, the one thing we know is that emergencies will crop up. You'll need new cars, your kids will get older, you'll decide you need a vacation, all of that stuff will happen. And if you haven't solved the underlying problem and you haven't gotten to a cash positive position, you'll take on more debt in addition to the consolidated debt you already put in your home equity line. And that's what I worry about for that. 31%, I was sad when I saw this, 31% use it for tuition or college expenses.
Oh boy. Yeah,
Yeah,
that
I
is
hate
sad.
that.
But you don't think that's a good idea, obviously.
Well, I understand why we do it, right? I understand you don't want to say no to your kids, and there seems to be no other way to do it, and you don't want these other loans, and you believe it's tax deductible and all of that, and so you put it on your home equity line. And it's kind of an easy, one check solution. But I would prefer that you took it out in the student loans, believe it or not, even at the slightly higher interest rates, as long as you're going to do something like our program where we muscle those interest rates down. Most of our people with mortgages and student loans and all of that pay less than 3% overall. So and a lot of times it's in the 2% range, right?
Wow.
So that's worth doing. If we can keep the debts separate and not encumber your home for it, I would prefer to do that. Because if you think about it, Denise, if you're encumbering your home to send your kids to college, you are probably nearing retirement age.
Right.
And I don't want you to use the equity in your home to pay for your children's education at your own expense for your retirement. I want you to be able to retire well.
And then what happens if you retire before that's paid off?
Yeah, well, what happens is people can't retire because it can't be paid off.
Right.
Or they do retire and they go downhill financially, or they deplete their assets by too much. And even more, what happens if you do this to send your kid to college, and your kid now gets out of college and either didn't graduate or graduated, but their income isn't enough to pay these loans? So the idea in the beginning is, we'll just take it out on the home equity line because we don't want to say no to our child, and the child will repay us and be our retirement plan at the end. Very dangerous way to use it.
Oh, yeah.
So here was probably the most disturbing for me, and you'd be surprised. It's not the vacation. Vacation, 2.9% of people use it to pay for vacations.
That's what my friends do. Yeah.
Yeah, well, that tells me that people are feeling really stressed.
Mm-hmm.
When you're thinking about, we absolutely need a vacation and the only way we're going to do it is to borrow against our house, that tells me, there's a problem brewing and you need to pay attention to it. But no, 14.8%, almost 15%, you think it's okay to use their home equity to keep up with regular household bills.
Wow.
Yeah, it's pretty high, 15%.
So we're talking about things like utilities and maybe your food bill and
Yep.
things like that.
Yep. And again, what the underlying message here over and over and over again is, no matter how many people we think are experts in finances, no matter how many people we turn to, our family members, our bankers, our accountants, our financial planners, no matter what happens, it seems to me, and this is why we started the company we started in 2008, that there was such a gap of people who would teach us about basic financial skills of anybody in our corner. Almost everybody we speak to has something to gain from giving us a loan or selling us an investment or doing something like that. Now, I'm not saying that's wrong. They need to make a living too, and if they do a good job, that's great. But who really is in our corner teaching us, for instance, about an 80-20 way to skirt private mortgage insurance, or how not to over-improve our house, or how to figure out what our safety zone is for buying a car or anything like that?
I searched for someone like
Right.
that for years and years, and here
Me
you
too.
are.
Me too. That's how I got here. I mean, I wasn't getting these answers either. So, 9% of these people buy appliances and big ticket items on their home equity line. 0.9% buy a boat. Less than 1% buy a boat. I thought that was good. Less than 0.75% used it for plastic surgery.
Wow.
Isn't this fun? I love the questions they ask. And 6.4% in the survey actually refused to answer at all. So,
they're too embarrassed to say.
Well, maybe. I don't know. Or they just didn't think it was anybody's business, and they said they weren't going to answer the survey. But, during the break, we were talking about this tax deduction.
Yeah.
And you said it was an interesting piece. And I think we all have been walking around just thinking if you get a home equity line, the interest you pay is deductible. It's almost a one-sentence answer.
Right. I always thought that.
Yeah. And I check with your accountant, but what I'm reading about it, what I know about it, is that it's deductible if it's spent on the house that you secure the loan with.
Not on a boat.
Not on a boat, not on consolidated debt, not on a vacation, not on sending your kid to college. There's a lot of reasons here that people are using their home equity line and probably blithely deducting the interest. And if they get audited, I don't know if there could be a problem. So it's a real question to ask your accountant. That's where I say, look, I'm not an accountant, I'm not an attorney, but I'm a great sounding board. I'm here to hold the mirror up and remind you, ask these questions because they could really pay off. So how did this happen? I guess let's talk a little bit about how it happened. There was a time where we did not access the equity in our homes. I remember it. I'm old enough to remember that.
You mean it wasn't an option? It wasn't a product that was available to homeowners?
Right.
Yeah.
Right. I mean, we had a mortgage, and the mortgage was to buy the home, and you spent your life trying to pay it down.
And then you burned that mortgage after 30 years.
That's funny. Someone was just in my office actually saying that they remembered in Turner's Falls, they remembered mortgage burning ceremonies up on the hill of people that worked in the factories when they could burn their mortgage. And they had personal accountances of
big celebration.
Yeah. So without getting into a lot of the history, at some point, the government decided that people were struggling financially and were taking on, needed home improvements, were taking on debt, whatever. And they thought, there's all this equity in these homes out there. What if we allowed them to use that equity? Well, that solved a number of problems. It gave banks a new loan. It gave people a way to get money to pump into the economy. But what I think it did is it gave them another way to take on debt. If you can think about, if you already have a home equity line, first of all, see if you even remember what made up that home equity line, what comprised all the debt that is now your $30,000, $40,000, $50,000 home equity line. And if you can't pass that test, I'm not surprised. But even if you can, try and imagine if you had not had that home equity line available, how you would have made the decisions to do the things you did. Would you have found another way to put windows in your home, or would you have said, you know what, we can't afford triple pane windows, we're going to put plastic kits over our windows like we used to in the old days, right? I know this stuff seems ridiculous now. We're so used to living a lifestyle. And I keep saying, please live below your means. Don't live within them. Live below your means because hard times will come. You see it in the market all the time. We've been in an up and down market. Market has its worst day. Market has its best day. This is not a guarantee. We're not on a straight trajectory. Your home values will not continue to increase every year, despite what you think. And despite if you think, hey, if I put in a new kitchen, my house is now worth $30,000 more because I spent $30,000 putting in the kitchen. I'm sorry, but that's not how it works. So you really do have to pay attention to these kinds of things. But that's how it happened. We got this sort of propaganda of home equity lines and why to use them. And they became very easy to borrow on. You get fast money. You don't have a lot of closing costs. They can get pushed through pretty quickly. And, as I said, I did this once myself and had those two home equity lines. And believe me, once I realized what had happened and how we had used equity in those homes, and then, in fact, probably owed more on them than we paid when we started out, just to try to get ourselves out of the position we were in. Once I realized that, I thought, I have to be able to speak to people about this and never go here again.
And if someone wants more information from you, Dr. Frances Ram, about their home equity line, whether they should do that, access that or not, or what to do with the current debt that they have, or debt consolidation, all of these questions, they can call you or they can go to your website.
They can, and I just want people to realize no matter how much I say do this or don't do that in general terms on this show, everybody's case is different, and we will help you make decisions that are wise for yourself, right? And it's all with your input. So they can reach us at 413-774-5555, 773-3333, or hugyourstudentdebt.org or hugyourdebt.org.
Thank you, Dr. Ram, for
Thank
all of
you.
this great information. And we want to thank our sponsors, People's United Bank of Amherst, home of Tea with Trish, and Greenfield Community College, increasing access to higher education at a fraction of the cost. You can access the podcast of this program at WHMP.com. Thanks so much for joining us this morning, and join us again next Saturday morning at 8 for Financial Fitness with the Money Doctor.